You ever wonder how a war, happening thousands of miles away, can suddenly make the stock market jittery and send gas prices soaring? It's a great question. We tend to focus on the physical side of war, but you know what? Its most immediate global impact isn't on buildings, it's on something way more fluid: money.
So let's get right into it. How can a single, regional conflict send these massive financial shockwaves across the entire planet? I'm talking about things that affect everything from Wall Street down to your wallet. Well, once you see how the dominoes are set up, you realize that modern war isn't just geopolitics. It's a full-blown global financial event. You see, the real story here isn't just about the headlines. It's about the systems that our entire modern world runs on: our energy, our trade, and our finances. And when one of those systems gets a shock, trust me, the consequences don't stay local for long. They go global, and they go fast. So where does a story like this even begin? Well, it starts in a very real, very specific, physical place. A place that acts as one of the most critical choke points for the entire world economy. Meet the Strait of Hormuz. I mean, on a map, it just looks like a little strip of water, right? But economically, it is an absolute giant. Think about this. About a fifth of the entire world's daily oil supply has to get squeezed through this one single choke point. And this is the perfect way to think about it. If the global economy is a body, then energy, oil and gas, is its blood. And that makes the Strait of Hormuz one of its main arteries. So, what do you think happens when you start to pinch that artery? The whole system feels it. Not later, immediately.
And look, this isn't some theoretical what-if scenario. This is happening right now. The UN is already warning that these disruptions are putting real financial pressure on the entire globe.
Okay, so the artery is getting squeezed, but how does that physical pressure turn into market chaos almost overnight? Well, the shockwave hits the financial markets first, and those markets, they run on one powerful emotion more than anything else: fear.
This is so important to understand. You and I, we tend to react to what's happening right now. We see that gas prices have gone up, but markets, they operate completely differently. They're always looking ahead. They react instantly to what might happen next, to the risk of a shortage, not the shortage itself. And you can see that fear priced in right here. After the latest fears of escalation, U.S. crude oil shot up over 11%, and Brent crude jumped almost 8%. Now remember, this isn't because there's a physical shortage today. This is the market placing a huge financial bet on there being a shortage tomorrow.
This right here captures a hidden cost that most of us never see. When the risk of shipping something through a dangerous area goes up, so does the cost of insurance and the shipping rates themselves. It becomes a kind of tax, a tax on the very movement our economy is built on.
All right, so the shock hits oil and shipping, but it never ever stops there. This is the point where that first impact starts to spread out, creating a really dangerous economic ripple effect.
Because for the wider economy, the real danger isn't just a higher oil price. No, it's the impossible puzzle it gives to central banks. They've been trying to fight inflation, right? Well, a spike in energy could undo all that work, so what do? Keep interest rates high and risk a recession, or cut them and risk runaway inflation? That uncertainty is absolute poison for the markets.
This slide just lays out the whole chain reaction perfectly. Let's trace it. So step 1, the war creates a supply risk. Step 2, boom, oil prices jump. Step 3, that sparks fears of inflation coming back. Step 4, this creates total uncertainty for central banks on interest rates. Step 5, stock markets hate uncertainty, so they get super volatile. And finally, step 6, all of this put together just ratchets up the risk of a global slowdown. It's a perfect economic storm.
So let's bring this all down from the 30,000-foot view of markets and finance. What does this stuff actually mean for people in the real world? Well, these financial shockwaves have very real consequences, and they tend to hit us in layers.
The first layer is the one we all see and feel right away. It's the price you pay at the gas pump. That's always the front line when there's an oil shock.
It's pretty straightforward, right? Higher crude oil means more expensive gasoline for your car. It also means more expensive diesel for the trucks that deliver, well, literally everything we buy. When transportation costs go up, the cost of every single thing that gets put on a truck goes up with it. Which leads us directly to the second layer. And this is one a lot of people might not immediately connect to a war far away: your grocery bill. I mean, think about it. Food doesn't just magically appear in the store. It's grown using energy. It's harvested with machines that run on diesel. It's packaged and shipped and refrigerated, all using energy. Energy is a fundamental ingredient in our food, which is why when energy prices go up, food prices almost always follow. But here's the thing. This economic pain isn't spread out equally.
The third layer of this whole thing hits the world's most vulnerable economies the hardest. It creates a crisis that goes way beyond just Wall Street.
And here's why. These countries often have to import their fuel, so they're paying those higher prices immediately. On top of that, many of them borrow money in US dollars, which tends to get stronger and more expensive during a crisis. They're getting squeezed from every direction, which is why the UN is warning that financial stress is really building up in these regions.
So, if we pull the lens all the way back, what does this one event really teach us about the world we've built? It shows us that we live in this incredibly interconnected system, but maybe it's also an incredibly fragile one. This quote just hits the nail on the head, doesn't it? For decades, the big idea was globalization, making everything more efficient. And hey, it worked. Goods got cheaper, supply chains got faster, the whole thing was optimized.
But there was a trade-off. In that race for total optimization, we took out all the buffers, all the slack in the system. We basically designed a world that works perfectly as long as nothing goes wrong. So when one key artery gets squeezed, the whole body starts to shake. And that really leaves us with a big final question to think about. If just one regional conflict can set off this kind of global financial chain reaction so quickly, it really makes you wonder, just how fragile is this system that we all depend on? How fragile is it really?